Alright guys, I just wanted to put together this quick video for you, kind of show you how we're game planning here for, if there's any type of market shakeout or market mayhem, how we're game planning to handle those different scenarios. As you've read through my email, obviously election day is a big day. The media can take a hold of it and make it maybe a little more sensational than it needs to be, but I hope you got an opportunity to vote. And as we watch the election results come in and digest the data from the market come in, we can make adjustments as we go along. Obviously, whenever we make these videos for you guys, just know it's for informational, educational purposes. There's no way for us to know your personal situation unless you're a client of ours. So don't be using this as a basis for investment decisions. If you want a full disclosure in terms of use, you can go to the website listed there and check it out. But as we talked about, I'm not going to get too into the details for the midterm elections happening today, but there's 33 seats up in the Senate. There's 435 seats obviously in the House of Representatives, and there's some governorships also up. And as we've heard, based on who wins the Senate, or currently the Republicans hold the House and the Senate, and depending on who you read or what station you watch, they're predicting outcomes. And then also trying to attach what the market might do based on those outcomes. The reality is we don't know. Nobody does. We have to wait for the data to come in, the election results to come in. We have to wait for the market data to come in, right? Price itself. But we've been down this road before, as I alluded to in my email. We've been down the road of what the media has predicted versus what actually happens, right? Remember, I don't know if you remember this, but back in November of 2016, very hard push. All the polls and things were saying that should be a landslide win for Hillary Clinton. We know the opposite obviously happened. At the same time, people were saying if there was a Donald Trump as president, the market would crash, and that's why we have to examine these things after the fact. We have to keep in mind and hold the media in check as far as the information they're providing. Was it accurate? So they were alluding to a big election win for a President Clinton. When in fact a President Trump was elected, then it was predicted that there would be a huge market crash. Obviously we know from that point forward, and we've been able to capture this move for our clients since that presidential election. Now, we got involved with the market not because of the presidential election. We got involved with the market because the data said so. Within 7 days after the presidential election, it became quite obvious that more and more stocks were participating in the upside, and it was time to participate again. And so we could get involved and capture a big part of that move. Now, whether that happens after this midterm election, we don't know. We don't want to make an assumption just based off of our gut instinct or what the media says, or because we have a favorite party that there's going to be some certain market outcome. We do know that there's typically volatility in midterm election years. This chart here shows that 1 year after a correction is the green bar. So typically there is a correction during a midterm year. This goes back to 1962, anywhere from -7% all the way to -38% from a high to a low in any of those midterm years. And then from that low, how high did the market get after that point? So for example, here in 1974, they had a 38% correction, and it gained all of it back 1 year after that correction. So there's volatility. This chart here doesn't give us any information as to the future. It just gives us the idea that we know that market years or midterm market years are volatile. And as our clients know, heading into October here, before the sell-off, and as the sell-off was occurring, we raised cash levels. Obviously, we didn't raise 100% cash. As we get into how the Adaptiv System works, that wouldn't fit within the rules, but we did raise some cash to cushion that drawdown. And we know that in midterm years, we can possibly have a period where the fourth quarter is very nice. The average, a midterm election year in the fourth quarter has about a 7.5% return, but we know how averages work, right? I always give the example of the average temperature in Wisconsin is 48 degrees, right? We know that's dictated by extremes. So we can't make predictions. It doesn't make sense to have predictions. It makes more sense to have a plan, right? We need to game plan for scenarios. There's 36 potential scenarios when we look at midterm elections and markets, right? You can have what happens in the Senate, what happens in the House. You can look at what's going to happen in the days to weeks to come versus weeks to months, right? That's two different time frames. You could have a market reaction tomorrow through the next couple of weeks that differs very different from what's happening 6 months from now. So you could have the Democrats win the Senate and the House, and we could be up days to weeks from now, up weeks to months from now. But the way we look at it is the elections are going to be the elections, the results are going to be the results. We're just going to deal with the data, and really that data is what are buyers and sellers showing us? What is economic law showing us, right? Well, that's price. That's the interaction of supply and demand, facts. We can't argue with them. So that's what we're going to use. We're going to concentrate on that data, not the opinion of what's on TV or the internet, just the facts on hand. And we do that by using the Adaptiv System, right? That helps us focus on the signal. So jumping real quick onto how this works, because some of you may be new on this video. Here's the S&P 500. The way to think about it is the 500 largest US stocks in one basket. It goes back to the late 90s. We can see supply and demand happening throughout the market, right? More supply than demand pushing prices down, more demand than supply pushing prices up. And this happens over and over and over in markets. What we do to identify trend, okay, now we're getting into how we're identifying trend within an asset class, because we can use what I'm about to show you, these orange and blue lines on anything. In this case, we're going to use the S&P 500, which is a pretty good proxy for the US market. But here, this blue line that's running through here is the prior 40 weeks of information averaged, okay? That helps us identify trend. It helps us remove our nose from the movie screen, if you will, and see the big picture. Are we in an uptrend or are we in a downtrend? Then what we do is we combine that with a shorter term average. This orange line on here is the prior 10 weeks of information. So blue line, 40 weeks of information, orange line, 10 weeks of information. What we know from the data is that when orange is below blue, that's when bad things tend to happen. Okay, that doesn't guarantee bad things to happen, but it's very much like saying, hey, if it's below 32 degrees and we're getting precipitation, we know snow is likely. Maybe we shouldn't park the car, or maybe we shouldn't drive the car, we should park it. Same thing in markets. We know that when orange is below blue, selling picks up, volatility picks up. There's too much risk compared to reward, right? We're only involved in markets to grow accounts because of the reward, right? We want to outpace inflation. We want to outpace healthcare costs, etc., as we head towards retirement. That's what we use this system for. So when orange is below blue, it's really that simple. We're going to protect accounts. Okay, we can do that in a variety of ways. We can do that by raising cash or holding cash. We can do that by holding something else that orange is above blue on. But quite frankly, orange above blue, we're going to be involved with markets like this. Orange below blue, we're going to be protecting. And it really is that simple, and we stay pretty disciplined to that process. And so it helps us, avoid, for giving you something to compare to. This 2000 high down into this 2003 low, that's about a 50% drop. Same thing during the great financial crisis is about a 60% drop. It helps us avoid those, right? Because if you have a 50% drop, right? If you have $100 and it drops to 50, just to get back to 100, you have to have 100% return. And so we're in the business of protecting accounts when it makes sense to protect, participating in markets when it makes sense to participate. This is what leads me into today and where we are with the midterm elections and any type of market reaction from it. Some of you might remember from the last video we did where I talked about the implications of the October sell-off that had just started. Back when I gave that presentation, it was near this day here. We had started reducing equity exposure for our clients to cushion this drawdown. Obviously, orange is above blue, so this is an environment we still want to be involved in. However, you'll notice, if we can say orange above blue is summer and we want to be strongly involved with the market, I would also point out that there's periods of where orange is falling and orange is rising. That would be more like fall. Okay, fall can have some nasty weather. We've had some nasty weather in Wisconsin here recently. A bunch of inches of rain plus cold temps. We know what that's like. That's what the environment we're in right now. We have a falling 10-week moving average, and now this is a new development. Even after a couple weeks ago, we have a blue line that is now flat. Okay, so the prior 40 weeks of price action is now flat on an average basis. That's closer to winter than we were a couple weeks ago. How did we identify that this could be potentially an issue and that we reduced exposure? If you could view a marathon race from the very start, right? At a start of a marathon race, all the runners are participating, everybody's strong. Same thing in markets. We can look inside of markets and look, it's not just a stock market, it's a market of stocks. And we can look at the individual stocks and say, how many of these are participating in the uptrend? Okay, as there's less and less stocks participating, that means you're late in the race. Just like a marathon race, when you look towards the end, there's only a few runners in the lead. That's what we were noticing in August and September, and led us to raise cash as we broke below these levels. Okay, so we are still in what I would call an elevated risk. Okay, now there may be some opportunity. That doesn't mean that it's sell everything and get to cash. We are in more of a neutral, cautious position, right? And one thing I'll also highlight is notice how price itself is now below blue. Okay, this whole run up since the 2016, price has not dipped below this blue line, and now here we are. And so that's a higher risk environment. And so our clients know that whether you're in our moderate portfolio, which is holding about 50% cash equivalency, or you're in our growth model, which is holding about 35% cash equivalency, we are in a cautious stance, ready to redeploy, okay, if it makes sense, or ready to protect even more if it makes sense, depending on where the market goes near term and intermediate term. Another way to look at it is you'll notice the interaction of supply and demand. Okay, it's no coincidence that buyers show up in the same places, right? Buyers keep showing up. I've highlighted other areas here. There are price levels that are important. It's an area of interest between buyers and sellers. We broke some pretty important levels back here starting at the beginning of October. Okay, the way we view this, so think about this psychologically, all right? If you are someone who bought in this area, okay, I'm trying to make a box here for you guys so you can see it. I know it's a bunch of arrows, so forgive me. But if you bought in this box, all right, think about what your reaction would be if price got back up to that level. So you invested here, you lost 10%, maybe even more, and now price gets back up into this box. What are you doing? You're selling. And so what we call this is overhead supply. Okay, this is where all the dead bodies are buried, right? And so we need to keep in mind that in this area above here is going to be a tremendous amount of resistance. Okay, you can even see it right now that we are running into an area of resistance right here. Okay, where we are current day. We're right up against the blue line. This is an area where sellers have shown up before, so we are in what's called a prove it market. This market needs to prove to us that buyers are in control. Okay, as I mentioned before, there's a little more risk, okay, because we're in an environment, this orange line is falling now, and this blue line is now even. That is a much different environment than one back here where both are rising together. Okay, now we did have an environment here where the orange was dropping and blue is going this direction. Okay, and look at how violent it was. So what you can expect is large moves. And what we're going to do is just take it incrementally, step by step. 2750 is an important level along here. Okay, near 2800 is also an important level along here. 2675 is important. 2600 is important. So we're going to take it step by step. Now, if we begin to see sellers really enter the market and we can see that orange starts to cross below blue, you know, if we get an environment like this where blue is coming like this and orange crosses below, we will be moving to complete protective action, meaning we'll be carrying extreme levels of cash and only owning those things where orange is above blue. That's the difference between us and a lot of different places. A lot of different places will say ride that out. We don't need to do that because we have the data here. We have a plan for up, down, or sideways, right? We could also see price recover. We could see buyers drive price back above here. And if we're back above these areas here, we will be more than happy to participate for our clients. That means we have calmer seas. You can expect smaller price moves. It allows for capturing more reward than the risk that's on the table currently. So we are in a high risk environment. Caution is the word of the day. We will be having large moves because, as example, the VIX is elevated. That's an instrument that gauges how much volatility there is in the market. So 1% moves on a daily basis should be expected. But that's our game plan for now. We're going to take it day by day. If price turns down, we can always protect based on levels. And then if orange crosses below blue, we're going to protect accounts. If price moves back above, we can redeploy cash and take advantage. There's no need to be driving 75 miles an hour through a construction zone. Same thing, we don't have to be all the way invested in an environment like this. We can wait for things to clear out. If through the construction zone it makes sense to drive 70 miles an hour again, we can do that. If it makes sense to park the car, we can do that too. So I hope that gives you kind of an example of what the way we're thinking about things. I hope you appreciated this game planning approach, right? We're ready for up, down, or sideways, no matter the outcome of the midterm elections. Hope you went out and voted. As always, you can always reach out to me or anybody at our team. You can call 262-335-1700, or you can email us at myteam@clientfirsttaxandwealth.com. I appreciate your time. Thanks for watching this video.